The General Authority of Zakah and Tax would like to thank you all for attending this workshop, which will discuss the transfer pricing in Saudi Arabia in light of the newly issued transfer pricing bylaws. So this session will be both in Arabic and English. So we will start with the English, and then we will have a QA session, English, and then Arabic presentation, as well as the QA in Arabic. So if you have any questions, I would prefer that you keep it till the end of the session. So those are the content that we are planning to present today. We will talk about the introduction about transfer pricing and the PIPS package. And then we will talk about the arm's length, the scope of the bylaw, to whom the bylaw is applicable, and then we will talk about related person definitions, as well as related party transactions. Then we will dive into the comparability analysis, which is the cornerstone of transfer pricing. And then we will talk about the method, and last we will talk about the transfer pricing requirement, which is the disclosure form along with the documentation, which is the local file, master file, CBC report, which is the country by country report, and how to comply with this newly issued requirement. So first, we would like to talk about the PIPS action, which is the pace, erosion, and profit shifting, which set a variety of measures to address the gap between the international, or the globalizations and international taxations. As you know, recently globalization is the major driver of businesses, and hence the transfer pricing arises from that, and the PIPS actions are measures intends to address these concerns. So the PIPS package was initiated by the G20 countries in 2012, and it was drafted by the OECD, and then it was approved in 2013. The package consists of 15 action points. 4 of them are the minimum requirement that the countries need to adhere to. Those minimum are the action 5, harmful tax practices, and then we have action 6, which is treaty abuse, then action 13, transfer pricing documentation, and the last one is action 14, which is dispute resolutions. But for our own purposes, which is transfer pricing, we mainly focus on action 8, 9, 10, and action 13, which belongs to the transfer pricing documentation. As I have said at the beginning, the transfer pricing is a result of the globalizations of businesses. So as you see here, the definitions of the related persons, it covers all the directions that the business has. So in this example here, we have a parent company. The parent company holds 2 subsidiaries. So any transaction that takes place between the holding company and the subsidiaries are called transfer pricing, and it has to be measured at the arm's length principle, which we will talk excessive about when we come later in the session. And also, any transaction between subsidiaries and subsidiaries are also considered related party transactions that need to be measured based on the arm's length. Additionally, any transaction this subsidiary have with its own subsidiaries, which would be here, these transactions also fall within the scope of transfer pricing and must be done within the arm's length. So transfer pricing covers all, or the scope of transfer pricing covers all related parties transactions, and we will come into the definition of what makes the related person, what makes a person is a related parties to the company, and what transaction that need to be covered within the scope of the bylaw. So the transfer that take place between all these parties, whether it is a loan, whether it is a transfer of goods, tangible and intangible assets, all these must be measured within the arm's length, or by the arm's length price. So now we will move to talk more about the arm's length principle with our experts here, Oscar Good.
Salam alaikum. Kayf al-hal. That's pretty much what I can say in Arabic. Unfortunately, my Arabic is probably as poor as your Swedish is. I'm coming from Sweden. I have a background from the Swedish Tax Authority, so I worked with transfer pricing for more than 15 years. That's my only specialty, so don't ask any VAT issues or questions because I'm useless in VAT. I have a background in introducing transfer pricing in 15, 16 different countries for the World Bank, for Asian Development Bank, for European Union. So I'm addicted to transfer pricing, and that's why I'm standing here today. Now I'm a full-time employee for gases, and I'm very happy to be here today. Most welcome, you too. So let's move on to the arm's length principle. What is that? I know some of you in this room are very skilled in transfer pricing and will think that what I say now is very basic. For some of you, you're not going to be that skilled and it might be too difficult. I'm going to try to be, at some point, very easy and sometimes make it a little bit more complicated. So hopefully I can cover some issues from many different perspectives. So the arm's length principle, that's the most important thing in transfer pricing. That's what it's all about. And it means that if you're a related person, if you belong to this kind of group that Wasal just explained, you need to deal within the group as if you were independent parties. So you need to deal at arm's length. So what you have to do in every transaction you do is to put yourself in the shoes of what would I do if I was selling or buying from an unrelated person? Would the price or the remuneration be exactly the same as in the transaction between the related persons, your subsidiary in the group or your parent or some associate companies in the group? That's the main issue you need to ask yourself each and every time. And if the answer is yes, perfect. Then you have arm's length prices. But if the answer is no, you need to do some extra thinking and maybe try to establish what is the arm's length price? What is the market price? So I'm going to give you a simple example of transfer mispricing. So let's assume that this is the arm's length price. So I'm starting from what should have been the right price, and then I'm going to show you what can happen if you don't have the right price. So here you have a manufacturer. In the group, there is a subsidiary. So they are a related person, they belong to each other. The manufacturer has a revenue of 1,000. This is the sales price. This is the TP transaction with a subsidiary in another country. The manufacturer has COGS of 700, other costs of 200. They make a profit of 100. The tax rate is 20, just as in KSA. So they're going to pay 20 in country A. In the other country, they sell to unrelated persons. So this company is going to receive some goods and they're going to sell it to third parties. So of course that price is arm's length because it's with a third party. That's always going to be arm's length. This is the problem. Should the 1,000 be 1,000? They have other COGS or costs for 300. They have a profit of 50. The tax rate is 10. They're going to pay 5 in tax in country B. Okay, so this is the example when it's arm's length. What they can do, either on purpose or it just happens by coincidence, it doesn't matter. Still, you need to make sure you have arm's length prices. But just by knowing this by 9%, you're going to lower the tax burden of 36% in the whole group. And I'm going to show that example now. So now I've lowered the revenue with 9%, which is not a very high figure, but the profit has gone down with 90%. So the taxes paid in KSA or in country A is only 2, just by lowering by 9%. In the other country, all by a sudden, the profit will go up quite remarkably, and the taxes they pay are a little bit more than before, but you can see the overall tax rate is 16 instead of 25 before, just by lowering the price with 9%. So that's how easy it is to make mistakes, or how easy it is to do transfer mispricing. And your job is to make sure that you comply with the arm's length principle and that you have the right prices within your group when you have related person transactions. So, scope of the bylaws. So, the 10th of December 2018, Gazette sent out a public consultation or the draft bylaws to the public to receive your comments. So that was the first time we showed the bylaws to you just to get your comments, and this was pretty much what we were intending to implement. But we wanted to make sure that if there was anything we missed, that we could include that as well. We received a lot of comments, and we took those into account, or most of them at least, when we introduced them the 15th of February 2019. The TP bylaws are applicable to all taxpayers and mixed taxpayers. So they're not applicable to zakat payers. So I'm going to go through that more in detail now. So all person subject to CIT, corporate income tax, or the income tax law, who are either 100% fully taxpayers or partially taxpayer, the so-called mixed company, they are covered by the TP bylaws. And then I started out saying that zakat payers are not covered, but it's not 100% correct, because it depends on if you belong to a group where the global revenue, the consolidated global revenue of the whole group is above 3.2 billion SAR, then the bylaws is applicable to the zakat payer, but only for Article 18. I'm going to come back to that. It has to do with something called country by country reporting. But I'm going to explain that later, so you don't have to worry. The exceptions are natural persons. So if there is any natural person in the room, you don't have to worry, you're not covered by the bylaw. But if you have, you're owner of a company, or maybe owner of two companies, and there are transactions with these two companies, they are covered by the bylaws. Or if there's a transaction from the company you own that has a transaction with a natural person, that company is covered. Then we also have another exception, and that is for companies that has intragroup transactions, related person transactions, which are less than 6 million SAR in a 12-month period. They don't have to comply with Articles 16 and 17, which concerns the master file and the local file. I'm going to explain the master file and local file later on, but shortly, master file is a high-level information about the whole group. The local file is very detailed information what happens in the local entity. So if the local entity is here, it's going to include all the information about the intragroup transactions. But for these companies that have less than 6 million in intragroup or related person transactions, they don't need to fill in this local file or master file. But they still need to show that they have arm's length prices. Because if there is an audit or if we ask questions to you, you need to be aware of that, okay, I have arm's length prices, and you need to be able to show Gazette that, yes, I comply with the arm's length principle, and this is the way I would treat an independent person as well if I was dealing with them. But, as I said, you don't need to have the master file and local file, but some proof that is arm's length. So here we try to do a table just to make it summarize all the different possibilities. So if you're a 100% taxpayer or a mixed taxpayer, yes, you're covered by everything. You're covered by the bylaws, you're covered by the disclosure form, you're covered by the local file, you're covered by the master file, and you're covered by the CDC report. The disclosure form is something Wasal is going to explain later. That is something called a transfer pricing disclosure form, where you shortly describe what intragroup transactions do you have, which need to be submitted together with the Form 8, your tax declaration. If you're 100% zakat payer, the only thing you need to think of in the bylaws is the CBC report. If you belong to a group that has more than 3.2 billion SAR in consolidated revenue for the whole group. Otherwise, as a zakat payer, you don't have to care about anything if you not belong to that kind of group. Natural person, as I said, you're not covered, so you don't have to care about the TP bylaws. 100% or mixed taxpayers, if the transactions are less than 6 million SAR, you're covered by the bylaws because you still need to behave at arm's length, so the transactions still need to be at market price. The disclosure form, you still have to fill in together with the Form 8, your tax declaration. But, as I mentioned earlier, master file and local file, you don't have to submit. Or not submit, but to maintain. You don't need to have that. And the CBC report, I said, yeah, if you have this limited transaction, it can still be that you belong to a huge group. So it might still be that you need to submit a CBC report or at least notify the Gazette that you belong to this kind of group and explain who is going to deliver this CBC report. Once again, I'm coming back to the CBC report. So now Wasal is going to help us with the related person definition.
Thank you, Oscar. Now, we have said at the beginning that transfer pricing's scope is only related persons transactions. And in order to know that these transactions, first you need to know who are those persons. Those are persons that are considered related persons to your organizations. So the first thing that we have two different type of related person triggers. The first one is through control. So simply one company own 50% or more of the other company. This means that these two companies are related persons, and any transaction that is done between them must be done on the arm's length basis, as Oscar explained. The other point is that if the related person's relationship could be triggered under effective control. What we mean by effective control, that when a company A own in company B less than 50%, but due to other factors, there is a control on that company. So the first test that has to take place is the ownership. If the ownership is below 50, then we go to the effective control, and taxpayers is required to carry out the full test in order to assess if that company has their effective control or not. So effective control can be triggered through governance, it can be triggered through business, and through funding. Through governance, here we are talking about, for example, company A owns less than 50% of company B, but some way they can appoint 50% or more of the board of directors of that company, then there is a control. The other way is through business. Let's assume company A has only one supplier. That supplier provides all the goods to it. So in this case, it could be that the supplier has an effective control on that company, and any transaction must be done within the arm's length basis. The last one is through funding, and we will come into detail about this. But it is very important to know that the effective controls are not decisive. So if you have, for example, if you have only one supplier that supplies all the raw materials and required material to do your product, it's not necessarily that they have effective control, because you need to carry out the full test in order to determine if there is effective control or not. So these are just the flags that you must do a complete test in order to assess if there is effective control or not. So we go back now to the first one, which is the through control. Here we have two ways of control or through ownership. We have the direct way and indirect way. In the direct way, it's straightforward. Company A owns 60% or 50% plus from company C. It means both companies are considered the related persons, and a transaction, as we have said, must be carried out on the arm's length basis. The other example, as you see here, we have company A that owns 60% of company B, and in return, company B owns 40% of company C. And at the same time, company A only owns 40% of company C. In this case, the 40% as a direct ownership is less than 50, but take into consideration that there is indirect control by company A on company C. So in this example, 40% of B multiplied by 60% of B multiplied by 40% of C, we got 24% of control between A and C, indirect control, plus we have the 40, so the total is 64, and that is considered more than 50%, and effective control is, ownership is triggered. And this person is considered related person. So any transaction now, this example between A and C, must be carried out based on the arm's length basis. Then as we have said, that these effective control are only triggers, are only flags, and it's not decisive, so you have to carry out the full test in order to determine there is effective control or not. We have discussed through governance, as the board ownership, through business, concentration of transaction, and then through funding. For funding, as you can see here, in this example, we have company A and company C. These companies are not related persons, so there is no ownership. Company A doesn't own anything in company C, whether direct or indirect. But company A gave company C a loan of 80 million SAR. So if we look to the balance sheet of company C here, they have the total funding. The loan is considered 80 million loan that was given by A to C, but that 80 million makes up more than 50% of the total borrowing of company C. Hence, the company the company A may have effective control on company C. I say may because, again, it is not decisive. You need to carry out the full test and determine if there is control or not. So in this example, we take the total borrowing, which is 70, and which is the long-term debt, as you see here in the balance sheet. We add to it the total equity, which is 100, the total equity here. We take out the return earning and OCI, other comprehensive income, if there are any. And then we got 130, which is the total borrowing before we got the 80s. So before we get the 80, we have 130. If we divide 80 and 130, that's 61. So it's more than 50%. So this is a flag that effective control could be triggered. Now we have defined the related person, so we know that this person is related to the company or not. Now we come into the transactions. What type of transactions that is covered? As you see here, we have 4 groups of transactions. We have goods transaction, where you sell and buy goods from the related persons. You have services, when you provide services to your parents, subsidiaries, your associate company, your sister company. And also we have financial loans that between related party, company A may give company C a loan. Not the case we talked about, but the case they have direct or indirect ownership, so it's not an effective control. And the last thing here we have the assets. So you're expected to categorize the transactions you have within these 4 groups. It's very important to note that global netting of transaction is not allowed. So you are expected to report transaction by transactions in the TB disclosure form, which we will come into it later. But the grouping of transaction is allowed only if you have done that transaction with same related person that resides in one jurisdictions, and you do that transaction with the same nature. When we say nature here, it means revenue or expense, because you cannot group revenue and expense and you net that. Netting is not allowed. And the last thing is the type. So you cannot group transaction. If you did 2 transactions with one related person, which is selling goods and selling assets, you cannot group them because they are of the different type. Different groups, you cannot combine them. Additionally, if you sold and bought goods from one related person, you cannot combine this together because the sign is different. One of them cash outflow, the other inflow. So the type is not the same, then you cannot consolidate them. So again, consolidation is allowed when you deal with one related person. If you have 4 transactions with one related person that is in the same jurisdiction, that have the same nature of these transactions and the time of the transaction are the same, then it is fine to group them. Otherwise, no. It's very important to note that here, just elaboration on what Oscar said, that natural persons are exempted from the bylaw, but transaction with natural person, if you are a company and you do transaction with a natural person, but that natural person is considered and if has an effective control or has ownership in the company, then this transaction must be at arm's length and must be reported as well in the disclosure form, as you will see later in these slides. Now we will continue with comparability analysis with Oscar.
Thanks, Faisal. I would like to stress 2 things before we continue. We have had 2 workshops earlier, 2 weeks ago, something like that, and a lot of questions were asked about effective control and some question about the global netting. So the effective control, Faisal stressed it many times, is not that just because you have more than 50% of the loans in his example, that doesn't mean that there is effective control. It's up to you to make sure that, no, I don't have effective control, and that you can show for the tax authority that, no, look here, I don't have effective control. Yes, I have 64% of the total borrowings, but still there is no effective control. So it's just that there is an assumption that there is effective control. Secondly, the global netting. In many of the countries I've been to, it's very popular to, especially tax advisor, but also the companies, to tell us, the tax authority, that, yeah, but the transaction KSA have with Brazil, okay, is not arm's length, so their KSA is making a loss of 4%. But the transaction we have with Sweden, it's too much, so there we're making too much profit. And if you look at the net of those two, it's arm's length. And that's a big no, never acceptable. We're not going to agree to it. Just to be very, very clear. So now let's move to the comparability analysis. So for you that are not used to transfer pricing, this is quite tricky. For the experts, this is not rocket science. But I'm going to try to hopefully explain to all persons here. A comparability analysis is the analysis to make sure, first of all, what is happening inside the group. To understand exactly which transactions do I have within the group. That's step one. Looking at market relations, what kind of goods, what functions do we have, micro and macro perspective, which risks are involved, understanding, identifying exactly what's happening within the group. That's the first step. The next step is to compare that with independent parties. And that's the tricky part, because I think most of you are quite aware of what's happening inside your group and who's doing what. That you can always identify. The tricky part is now you need to compare with unrelated persons and show that, yes, unrelated persons has the same price or the same margin or the same share or allocation of profit based on what I'm doing. And that's the tricky part, and that's what you need to provide to us, and you need to come up with some justification why this is arm's length, the transactions you have within the group. So the first part, there has been much more stress on the first part. There's something called OECD guidelines, which gives guidance for the whole world on how to deal with transfer pricing. And there was a new publication a couple of years back where they explained and focus much more on what is actually happening within the group, to identify what are the transactions in the group, how is the risk split, who's in charge of the risk, who's in control of that risk. So that's important for you to think of when you are at step one. What is actually happening? Not just saying that the agreement says that the other party is in control. Because if you are in control here in KSA, you should also bear the risk. Because it goes hand in hand. If you're in control of the risk, you should bear the risk. Because if you're not in control of the risk, you cannot bear the risk. Because that would never happen between independent parties. Secondly, you try to do the comparability, the second step in the comparability analysis. Usually, if you use a database, it's called a benchmark. So you do a benchmark to find independent companies doing similar transactions as you do, and you see what margin do they have, for example. And you apply the same margin on your transactions. Then you also need to select the TP method. Which transfer pricing method should I use? There are usually 5 methods. I'm going to come back to them very, very soon. Usually you use one of these 5 methods. I'm going to go through them step by step, and I'm going to give you examples, hopefully to clarify it a little bit more for you. But before we move to the methods, I'm going to go through the comparability analysis even more thoroughly, because there's a lot of things you need to think of. So first, you need to look at the contractual terms of the transaction. So what does the agreement says? And once again, try to get an agreement that is the same specifications as if you were dealing with a third party, an unrelated person. Because it should say in the agreement that the other party is bearing this risk, the goods we're selling are this amount, and the payment terms are 30 days or 90 days. Whatever is normal in a normal contract with third parties should also be in this contract. And make sure it makes sense. Because if it doesn't make sense, it's probably not arm's length. Then you do the functional analysis. That is, what kind of functions am I doing? Am I a manufacturer? Do I do contract R&D? Am I a distributor? Do I sell stuff? Is it a logistic function? Is it, what else could it be? Marketing function? Is it an intragroup service? So I only provide accounting or legal advice? Whatever. What is the actual function? You need to justify that. I will explain what it is. And once again, you need to look at the different risk in relation to all those different functions. What are the risks involved? And especially the significant risk, which are the most relevant risk, like follow the money. What is the worst thing that can happen or the best thing? Because risk is not just negative. A risk can also be a possibility. Explain that as well. And be sure that you have full control of who is bearing that risk. And also the contractual term should be the same as the risk allocation. So the agreement doesn't say something that party B is in control of the risk, but what's actually happening is that company A is the one that is in control and knows everything. Then the contract doesn't make sense. What kind of property is transferred? Is it service? Is it property? Is it an umbrella? Is it a truck? Or is it just a legal service? What kind of it is it? And then describe it. Is it high quality, low quality? Is it a premium product? Is the IP very important in this product? So try to know exactly what kind of property or services that has been provided. Then we have the economic circumstances of the market. So if you're looking at KSA, you need to be aware of the specification of KSA. What's typical for KSA? Is it a lot of governmental regulations? Is it a lot of competition? Whatever is particular for KSA. This is important to know because when you're going to do the comparison, you cannot compare maybe with Sweden because Sweden might not have the same kind of market situation, and then it's tricky to compare. So then maybe you want to compare with countries that are closer to KSA, but then we have the problem with, can we find that information? So for example, if we say Dubai, we have a KSA company that has a transaction with some other company in Germany, but it's the KSA company and the market here we compare with. If we want to compare with Dubai, it might be that we have to find financial information from Dubai or United Arab Emirates. The problem is there are no publicly available information, which probably means you need to go outside the region. And you might end up comparing with Asia or comparing with Colombia or some parts in Europe. That's your job to make sure, okay, this is the most comparable market I can find. Because you probably won't find comparables in KSA because there's no publicly available information yet. Unless there is an internal comparison you have in the company. So, for example, you're selling the same goods to unrelated persons as you're selling within the group. There you have an interesting comparable, and maybe you can use that one. And if you apply the same agreements, the same condition, the same risk allocation, maybe that's the perfect comparable. So don't forget about your own transaction as well with unrelated persons. And the last step, the business strategies. Is there a business strategy in your company here? It's very common that if you want to get market shares, you might lower the prices. And if you lower the prices, let's say you have a distributor here in KSA, and you're lowering these prices because you want to create market shares. You want to get a bigger market share. Of course, it makes sense to lower the prices and maybe you make a loss here for 1 year or 2 years. As long as you can show Gazette that this is okay, because we have a strategy. Look at our forecasts, look at our budgets. This says that yes, we're going to make a loss year 1 and 2, but year 3 and 4, when we have a much higher market share, we're going to make much more money. So if you can show that, then it makes sense, and the business strategy makes sense. And of course, when you have a business strategy, then it's difficult to compare with other companies that doesn't have the same business strategy. And then you need to make comparability analysis or adjustments for those differences. So now I'm finally coming to the 5 methods I talked about earlier. The transfer pricing methods that are usually applied are these 5. So we have something called CUP, Comparable Uncontrolled Price Method. We have a second method called resale minus or resale price method, RPM or R minus. You have a cost plus method, C plus, transactional net margin method, usually called TNMM because transactional net margin method is a very long word, so everyone usually says just TNMM. And finally, we have the profit split method, PSM. Profit split method is a little bit different to the others. I'm going to go into that deeper later. But all these 5 are, I think I've seen 1 or 2 examples worldwide where they don't use these 5. So it would surprise me if you can come up with a new method that is better than any of these 5. But absolutely, if you find a method that applies better and you can show that this is more arm's length than using any of the other 5, then it's acceptable. So first you need to go through these 5 then and say that no, none of these apply to me because they don't make sense. I have come up with this 6th method or a 7th method which makes even more sense. Okay, no problem, as long as you can show it's arm's length. So now we take them one by one. So comparable uncontrolled price method, the CUP. I'm going to start explaining the internal CUP because that's usually the one you can find. External CUP is quite difficult to find. So let's assume we have a company that belongs to a group, X company. They are selling umbrellas. They're selling 200,000 umbrellas for 20 SAR each. So they get 4 million SAR for this intragroup transaction. This is the TP transaction. Now we want to compare this transaction with a third-party transaction. So we're lucky the same company is also selling umbrellas to a third party. The same kind of umbrella, same quality, and actually the same amount of the quantity. But you see they sell for 2 SAR cheaper. So when they sell here, they only get 3.6 million SAR in total. So in this situation, we might have a problem. It might be that we need to adjust our internal prices because they are 10% less. And if you cannot justify that, no, but it depends on the market. The competition is much higher in this transaction compared to this one. If you can't make those kind of comparability adjustments, then you probably have to change this price to 18. Because this is for sure an arm's length price, because that's with a third party. It's a fact. The question is, should I have 18 or 20 here? Okay? External CUP. Then it will be difficult to continue looking at the umbrella example. Because if you're selling umbrellas in your group, I think you will have a hard time to find third parties selling exactly the same kind of umbrella, the same quality, and also finding all the prices for that. So let's go for commodities instead, because usually what they use external CUP for is for commodities, like oil or timber or minerals. That's usually when you can use the external CUP, because there is a market price, there is exchange, not stock exchange, the exchange markets where you can find the actual daily price for each product, and then you can make adjustment for the quality. So that's usually where you use the external CUP. So in this case, let's say it's gold, mineral gold. You're selling this 200 units of something and you pay 20. Once again, you find external companies selling exactly the same kind of gold, same quality, same amount, but the price is different. Once again, you probably need to do an adjustment down to 18 instead of 20, because the comparable transaction says 18, and that's the price you need to comply with to be arm's length. That was the CUP. Now we move on to the resale price method. Now we're looking at this company. So once again, we have a group of companies, X and Y. X is selling products to Y. Now we want to establish what gross margin should this company have. So they're selling the same products to third parties and customer. In this case, they have sold 100 products and they get 100,000. The purchase price, this price, is 75. So this is the TP transaction. In this case, they get 25% in resale margin or gross margin. The question is the 25 arm's length? Now we need to find independent comparables, independent companies dealing in the same similar, having the same function but selling similar goods. It doesn't have to be exactly the same good, but it needs to be similar goods. So now we found 3 comparable companies selling similar goods in similar way, having a similar contract, and hopefully a similar market. And we're looking at what margins do they have. They have 23, they have 27, and they have 17. And our question is, so we have decided these 3 are 100% comparable. So if this price is within these prices, it should be arm's length. And in this case, it is, because we have 17 and we have 25. That's the range. Once again, I'm sorry, I'm going to make it difficult for you, but this is tricky to find. It's tricky to find unrelated persons, to find all the information, all the financial information about this. So what you can do is, if you're lucky, this company might buying other sourcing products from an independent person and selling to a third party, then you have a comparable. Then you have an internal RPM. That's that's usually where you find the good RPM, because then you can say, yeah, but we're doing exactly the same thing. It's similar products, and you see I get the same gross margin. And then it's easier for you to justify that you have arm's length prices. Now we move to the third method, the cost plus. Now we have X company here. They are buying raw material from someone, or maybe some other products as well. And you want to look at the cost basis here and establish what should be the cost and the plus markup. The markup is the arm's length thing. You want to make sure you have a markup that is arm's length, because they are going to sell internally to Y company. And once again, we have a group here. So now we're looking at this price. What is the cost plus? In this case, when they sell to Y company, they get 11.2 million. They have cost of production of 8 million, and the cost plus markup in this case is going to be 40. Now we want to make sure that the cost plus of 40 is arm's length. So we have established that there are some comparable companies that we can use as in our comparability analysis and use as comparables. Now we look at their margins and we see 42, 46, 44. Unfortunately, the 40 is not within this range between 42 and 46. That means that probably this price, the 40 is not arm's length, unless there are differences between the market, and you can justify that no, these differences are due to other reasons that are at arm's length. So if you can justify that, you don't need to change. But if they are 100% comparable, then you should be within this range. We move on. Now we're probably coming, or not probably, we're coming to the most common method used. It's the TNMM, Transactional Net Margin method. Here you get something called tested party. And I'm introducing a new word here for some of you. But the tested party, when you're looking at your transaction, there's at least two parties involved. And the one party that has the least complex transaction, or the least complex functions, less risk, and doesn't own any intellectual property, like trademark, patents, know-how, customer list, etc. That's the tested party. That's the one you're going to compare with. So you take this, it could be outside KSA. So if it's between KSA and Switzerland, it might be that Switzerland is the tested party because they have less functions, less risk, and no IP. In KSA, we have trademark and we have patents and we're in control of all the risk. So now you're not going to compare with KSA any longer. You're going to compare with Switzerland. That company, you're then going to compare with unrelated persons. And now we're looking at margins, operating margins. What kind of operating margin should they have? What remuneration should they have for their function? So we look at our company, the tested party. In this case, they have revenue of 100, COGS of 80, OPEX of 16. They have an operating profit of 4, which is also an operating margin of 4. So now we want to test and make sure, is the 4 arm's length? In this case, we found 3 comparable companies which we think that they are doing exactly the same thing. So if I'm a distributor, I'm comparing with other distributors selling similar products. And you look at their margins. So yes, this has 3, this one has 5, this one has 6. This is within this range. So in this case, there is something called an interquartile range between 3 and 6%. And as long as you are within that range, you're arm's length. Of course, the trickiest part is to make sure you find the right comparables. So you can show the Gazette, if we ask you for this information, that those are the best comparables out there at the market. And if there are not anyone that is better, of course, this is going to be the arm's length range. And that's the one you're going to apply. Anything you want to add? And now the last method, the profit split method. It can be applied in many ways, but the 2 most common one is either contribution profit split or residual profit split. I'm going to start with the second one, residual profit split, because the first part you do in the residual profit split is that you provide basic return, routine return or remuneration to routine functions. So if you have two parties in the transaction, before you can establish which profit to allocate to the different parties involved, if one of them, or maybe both of them, are providing routine services, maybe there is contract R&D or contract manufacturing, which is a basic routine function, then they should get the remuneration first, and that's usually based on a T&MM. So you establish what should be the T&MM remuneration for this routine service. After you apply that, there's going to be a residual left. And that residual is what needs to be split between the different parties, depending on what they are contributing with, if you base it on cost or if it's the head count. It could be anything, but it has to make sense. So if you would split it the same with independent parties, you use the same application within the group. The contribution profit split, there is no basic return to anyone. Then you look at the overall profit, or in worst case scenario, it might be a loss that you need to share. You look at the overall profit, and you see how much, who has contributed with what, and then you get the allocation based on your contribution. So if someone has contributed with 75%, they should get 75% of the residual. Then you should get the 75%. And the other one should probably get 25% then, unless there's something strange going on with accounting. So that was the 5 methods. Now we're moving on to the disclosure form, the transfer pricing disclosure form. So this is a form which you need to declare together with your tax declaration. And Wasan will go through it very thoroughly, so you will know much more.
Thank you, Oscar. As we have mentioned in the beginning, there are new requirements as a result of this transfer pricing bylaw. The first requirement is the TB disclosure form or transfer pricing disclosure form, which we will discuss now. And we have the other requirement, which is the master file, local file, and country by country report. We will discuss these after the disclosure form. So disclosure form is a new requirement that is part of your tax declaration. So when you go to your tax declaration to fill it, you will find a new tab called transfer pricing that will be for disclosure requirement for transfer pricing by law. So the things that you need to disclose is as you see here. So you have the basic information and the income statement, additional balance sheet, and then this is the new tab, which is transfer pricing. Under transfer pricing, you have two things. The first thing, we call it the disclosure form, and the second, we call it the CBC notification, where you have to notify or tell gazettes who will submit the CBC report. So let's start first with the first question, which is, do you have any related person or bank transactions? You can answer yes or no. If you have a related person, then you must answer yes, regardless of the amount. But if you are a zakat payer, 100% zakat payer, then you are falling outside the TB bylaw, and you can answer no, even if you have related party transaction. So for the meantime, zakat payer are not required to submit this information. So if you selected yes, then the drop-down list will expand, where you have to provide information about the related person transaction you have. Of course, this step after you have identified who are your related persons based on the ownership, as we discussed, and based on the effective control as well. So here the first thing is the 4 group that we discussed: tangible, intangible, financial services. You have to select the type of the transaction, and then you add descriptions on that transaction. For example, if you bought raw material, then you have to add here bought raw material blah 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 from this taxpayer, which you mention his name here, which is the name of the related person from whom you bought that. You need to mention it here. Additionally, here you have to provide certain information like the address, the TIN number, so you can refer back to the transfer pricing guidelines, which is issued recently. That gives more information on what is required in this field. Then you have to select the tax jurisdictions of that related person with whom you did the transaction. Of course, this is a drop list. You have to select the list. And then you have to select the type of transaction, if that's revenue or expense. What we mean here is it inflow or outflow? Then you have to identify that and add the right figure, of course, in full amount here, whether it's expense or revenue. And the last thing, you have to select the method that you have used in order to assess the arm's length value of this transaction. You see the plus here, you can add as much as you want. It depends on the transaction. You have to add as many as you wish, but again, as we have discussed, consolidation only allowed under certain conditions. And then we ask the question, have you or the group gone through business restructuring? And during this period, during this tax reporting period, you have to answer yes if you had any, or no if not. No certain or no additional information is required whether you answered yes or no. And then we come into the total amount of revenue, expense, and profit and loss that you need to mention here. It's very important to note that this amount must match your tax declarations. It is not the accounting or the financial statement figures. Those are the tax declaration figures, which is after adjustment for tax accounting, which is the total revenue, total expense, and you have to add here whether it's a profit and loss, and you have to add the full figure. The next question is, have you maintained the transfer pricing documentations in line with the TB bylaw? These documentation, as Oscar had mentioned, which is the master file and the local file. If you have related party transaction or related person transactions that is less than 6 million in 12 months based on the arm's length, then you need to select not applicable, because as per the bylaw, you are not required to maintain these documents if your related party transaction based on the arm's length are less than 6 million within 12 months period. And then you have yes or no. If you have selected yes, you will get additional options here to select which document you have almost ready. This question is not asking you to have the full set of document ready, but you have enough information that can help you to prepare the local file and master file within a period of 30 days once you ask to do so. So you have to select which file do you have ready. Then it comes the question, do you have any barter transaction, which is exchange of goods or provision of services without money? So you are, like free of charge transaction or barter transaction. If you have selected yes, you have to report here the type description about that transaction that took place. Additionally, you have to add the name of that person or name of that related person with whom you have done the transaction, the barter transaction, and then also you have to select the jurisdiction of that related person. And then the last thing, you need to provide more information about the owners of the company. So if you are a taxpayer, you have to add here who are the owners. Of course, you have the plus here, you can add more as well as here. So you need to add the name of the owner, where he is located, and the percentage of ownership. It's very important to mention that if you are a public company, so there is a portion of your stocks are in the stock market, then if there is any owner who owns 5% or more of your stock, must be reported in a separate line here, and you do not combine them all. So here we are done with the first question, which belongs to the transfer pricing disclosure. The second question is called CBC notification, and both of them are an integral part of your tax declaration and must be submitted at the time you submit your tax declaration. So here, if you selected yes, you have only to select yes if you are part of a group that have a consolidated revenue of 3.2 billion SAR in a year. So if you are part of a group, in any group that has 3.2 billion SAR, then you need to answer yes, and you need to provide the following information. The information is divided into information about the UBE, which is the ultimate parent entity, which is the ultimate parent owner or is the ultimate owner of the group. You need to provide the legal name of that UBE, and then you need to provide also the tax declaration number of that UBE. Also, you need to provide the jurisdiction and the fiscal year. This is one part. The other part is about the reporting entity, because sometimes the UBE is not the reporting entity. In this case, you need to provide the UBE information in this in this section, and in this section you need to provide information about who will share or who will submit the CBC report. This information, again, similar to the EB information, you need to provide the name, the legal name of that reporting entity. You need to provide the TIN number, the jurisdictions, and the fiscal year. At this stage, of course, as we have said, no master file and local file required, and that will be required once asked for, and I believe Oscar will elaborate more on that. Oscar?
Thanks. So now we're moving to master file and local file. What documentation is needed? So this should not be submitted to Gazette. This is something you need to maintain. So whenever there is an audit, when we start an audit, then we're going to ask for this, and then you need to be ready to provide it to us. But nothing should be submitted together with the tax declaration. So what is the master file and local file? The master file contains high-level information, what is happening within the whole group. What are the key business drivers? What are the value drivers? Which are the important IP within this group? Of course, organizational structure, where you explain, okay, all these companies belong to this group. What are the main activities? Are we dealing in oil or in pharmaceutical? What kind of pharmaceutical are we dealing with? Which markets are we present at, etc., etc. Information about IP. In transfer pricing, intellectual property is extremely important. Usually, if you own a valuable intellectual property or intangible, like a trademark or patent, then if you're the owner of that one and you're the one that is in control of that intellectual property, you're also the one that's going to get a high part of the profit of the whole group if you're in control. Because you cannot own an IP if you're not in control of the IP. You cannot just be the legal owner. You also need to be in charge, making the decisions. Then, the IP is very, very important to be aware of. Who's the owner of that IP? What financial activities are going on within the group is, of course, important to know as well. Then we move to the local file, because the master file, I don't think, if you already belong to a big group today, is not a problem. I think you already have the master file in place. The local file, for some of you, especially if you're dealing within the region, it might be that there is no local file for the KSA company. Here we're digging into details. Here it should be something called the comparability analysis, the one I explained, like a benchmark, where you're showing that my prices are at arm's length. You're looking, of course, at the organizational structure that has an impact of you. So it's not, if you belong to a group that has 200 companies, maybe you don't need to provide the organizational structure for all 200 companies, but at least for the division you're part of, everything that has an impact of your KSA company. What are the business strategies? Do you know, I explained, if you have a business strategy, you need to explain that. Now, yeah, we're making a loss this year, but that's due to this and this and this. We're doing a market penetration. We're giving heavily expenditures in advertising. That's the reason why we make a loss. But we're going to be extremely profitable in 2 or 3 years. Perfect. But you need to describe that in your local file. If there is any IP in KSA, you need to describe that, yeah, the KSA company owns the customer list. We might have a production know-how. We own these 2 patents, and they are very important, or they're not important. But you need to describe this. Or it's maybe the other party of the transaction that is owning important IP. Then you need to explain that they are the owner, and that's why they're the owner, and it's a very useful and very valuable IP in this business. And then the financial activities going on, and also what kind of loans you have within the group. Any transaction that you have with the KSA company needs to be described in the local file and clearly specified, and what are the basis that this is arm's length. So if you have 3 functions or 3 different transactions with 3 different parties, you need to explain all of them and show that all of them are at arm's length. So the implementation of this. So normally you have 120 days after the end of the fiscal year of your company. After 120 days, you should submit the tax declaration. And at the same time, you should maintain the master and local file. But no, for the first year, there is some exemptions. So there is an extension of 60 days. So for 31st December fiscal year taxpayer, they should submit this in April. But in this case, they will get 60 extra days. Then it has to be a request from Gazette as well. So if there's a request, you at least get 30 more days to finalize the master file and the local file. So in those cases where we are going to start an audit, yes, then you need to start really finalizing it. But for all the rest, you always have the 180 days plus the 30. That's the minimum.
Just to mention here, these 30 days are the minimum. So those are the minimum we will ask you to submit. So it could go more than that, but not less than 30 days. Thank you.
Thanks. Best. So now we're moving to the CBC report. Vassal explained the CBC notification. You remember he showed the disclosure form and he said there is point 1, which is about your intragroup transactions. There was a second one, which is called the CBC notification, to show who is reporting this country by country report. Once again, it's only for the companies in this room that belong to a group where the global revenue is above 3.2 billion SAR. For the rest, you don't have to care. So if you belong to this kind of group, now you can listen. So if you are an ultimate parent entity, the UPE as Vassal explained, or if you're something called a surrogate parent entity. So what is that? Surrogate parent entity means that you're not the ultimate parent entity of the whole group, but you're still the one that's going to submit this CBC report. Then you are the surrogate parent entity. So you're taking the place of the ultimate parent entity because you're going to submit the CBC report. So there's only one CBC report, one country by country report in the whole group. And it's going to say the same thing for the whole group. Because you're going to show exactly what's happening within all the group and show which kind of transactions you have and what are the profitability in all the different jurisdictions you're present in. So if you're one of these, you have a consolidation revenue above 3.2 billion and you're the ultimate parent entity or surrogate parent entity, you need to submit this in KSA. There are some exemptions, so why should it be easy? So if you're a constituent entity, that's another interesting word, but constituent entity is just your legal entity. So if you're a legal entity that belongs to this kind of group, but you're not an ultimate parent entity or a surrogate parent entity, it might still be that you need to submit it locally under 3 conditions. And I'm going to go through these conditions. So if you're a legal entity in KSA, it might be that you have to report this under these 3 circumstances. So if the ultimate parent entity or the surrogate parent entity of the whole group is not obliged to provide this CBC report due to the domestic legislation in that country. So if you have a UPE in British Virgin Island, I don't remember if they have this domestic law, but let's say they're situated there and they don't have the domestic legislation. Then the Gazette will not be able to receive the CBC report, and therefore they need to do something called local filing here in KSA instead. The second exemption is if the UPE or SPE, they are normally obliged to submit the CBC report and it should be exchanged. The problem is there is no international treaty or no international agreement which is signed, so it's not in force, which means KSA will not be able to receive the CBC report from the ultimate parent entity or the surrogate parent entity. Then the constituent entity or the legal entity here in KSA has to submit it locally. And the third exemption is when the ultimate parent entity or the surrogate parent entity, the country they belong to, are doing something called systematic failure, which means they're not providing, they're not exchanging this. Because the CBC reports, they should be exchanged automatically between the tax authorities. But But if the tax authority board never provides the CBC reports to Gazette, there is a systematic failure, and the company, the constituent entity here, has to provide the CBC report locally. Okay.
Okay, just to again repeat what Oscar said. Now, for the CBC, we have the CBC report and we have the CBC notifications. The CBC notifications must be submitted by any company, it's whether the UBE, the SPE, or the constituent entity, if that group of that, let's say, taxpayer is part of a group whose total consolidated revenue is 3.2 billion and above. But the CBC, it has to be submitted by the UBE or SPE if they are in KSA. If they are not in KSA, then the constituent entity in KSA has to submit that report under these circumstances only. Other than that, Gazette will retrieve that report from the jurisdiction in which the UBE or the SPE resides.